Hi, this is Shane with the Rational Trader. It's Tuesday, the 20-something or other, 29th. I was out of the office the last couple of days, so trading both unattended and remote. And we actually have entered a new phase here starting on Monday. So let's review that. Today, my result for today was 6 ticks in oil, 4 in yen, 1 in gold, nothing in the 6E, but there's a reason. Well, anyway, we'll review it because we're using sort of the new phase stuff that I'm not quite completely ready yet. So that's a $95 cum P&L for the day. Let's review now where we stand. All right, so we had a long end of week review video that went out on Sunday that talked about the next step here. So we ran an experiment in December using one sort of analytical process applied to the machine learning system, and then a different one in January. So actually, let's look at those results. All right, so let's bring that up. Trade activity log, starting from 11:26 through it was 12:28. This is all symbols, non-sim. Okay. So this is all live accounts. So 2,028.75 gross. So that's before costs for that 4-week period. So pretty good. All right, you'd be very happy if you could do that regularly. Then we made a change, and the change we made was the analytical process we were using was to look for common behaviors across 6 months worth of data where we see the same behaviors repeat in more than once in each of these buckets. Okay, so we run the simulation using the data from the machine learning system, and then we look to see, okay, well, what behaviors are repeating? And there was some concern that you can find yourself sort of out of touch with the market. And so let's look at it a different way. This is the experiment I ran in January, was using a different analytical process to look at more recent behaviors. Now, you have a lot less data to work with here, so finding commonality doesn't work anymore because there isn't enough opportunity for all the different behaviors to show up. All right, and the result is it's a pretty resounding decision in favor of the first approach. Okay, so if we start from 1, 2, we're at 21.43, and we finish at 125. We're all the way down at 550. So that's 15. Call it $1,600 down. All right. So now, starting yesterday, I've implemented something new. So let's talk about that. So just taking a look at what we learned from these two experiments and applying them to the markets now. So there were no trades yesterday, which is why there's only one day here. Okay. So let's talk about this. One of the problems with the finding common behaviors is that it's quite difficult. It's a very laborious process is the first thing. It takes a long time to work to do that analysis. And so what I did is I wrote a program and to automate all of the grunt work. But then also in the writing of that program, it became clear what are the different factors that are important. And so what we're going to do is we're going to take this approach of finding common behaviors, okay, and we're going to refine it. So we're going this is going to get thrown out, and instead what we're doing now is I've written a program that allows me to look at the data and change the bucket size. So that's how many days are in each of these buckets. Okay. It allows me to change the trade, what I call the trade quality, or you've heard me call it before, the efficiency ratio. It's what is the profitability versus how many trades it took to achieve that profitability. Okay. But then also there's a concept of frequency. Well, how often do I need to see that trade show up in the list of high quality trades, or that behavior to show up in the list of high quality behaviors that occurred in each of the buckets? Okay, so whether it's twice or 3 times or 4 times, these are now knobs and dials I can turn. So I can very easily now change the bucket size to 2 weeks and look for more frequency with higher or lower trade quality. I can tune those values in the analysis and find the sweet spot for each one of them. And I did that for oil. I was able to finish that analysis for oil over the weekend. And so that's what's running in oil now. Oil has a set of behaviors. This went out to members that says these are the behaviors, long and short, that show the best combination that I could find, the optimal combination of bucket size to frequency to trade quality. And really what this outputs is two numbers that are useful to help understand if you've got something that is workable. All right. One is risk factor. Risk factor is really how often am I just taking a max loss divided by how many days are in the simulation run. And we want to see that number less than 20%. And more than that, and we even if you have high quality trades, just the fact that you've got a higher risk factor means it's very easy to get, it's much easier to get long stretches where you're just getting whacked. And we kind of saw that in January. Okay. And so what we want is I'm willing to miss more moves if it means I can keep that risk factor down, particularly since I want to trade multiple markets. So the idea is that I'm only looking for the absolute best trades that have shown to be of good quality, and I'm not gonna necessarily even look at the market to see, well, what happened that day, and kind of tie myself up in knots, getting upset that I missed a move or something like that. If I'm only looking for the best in each market and I'm trading a bunch of markets, then in theory, you're going to end up in a better place than with a much flatter curve here, with less of these spikes. Okay. So at this point, that's what I've started on Monday, but I've only got the CL analysis complete. These other markets, I wasn't able to really complete it. I wasn't happy with the answers that I was getting. So I just went super conservative. So very low risk factors, basically, is what I did. And so that's what's running in these markets, in the yen and gold and the euro, while I work through the rest of that analysis to see, okay, well, what is sort of the final number right now. And then what will happen is about every month, I imagine, that analysis gets redone. And so we basically, if we go back to here, every time we add another one of these buckets every 4 weeks, we go back and we do our analysis again. We drop the old bucket off, we put the new bucket on, and then redo the analysis and look at it, see how much change has occurred. All right. And that's my planned process here. So at this point, we got to start tracking it differently now. So we're going to start tracking weekly gains starting from 128. Okay. And I'll try and get these other markets up to speed as quick as I can in terms of the total number of behaviors we're looking for. There may be some more work is the issue. Gold in particular looks to me like I need to go to a faster chart, and that's a lot of effort. So if that's the case, that's what we'll do. But the others, the euro and the yen, I think are in a spot where I have the data that I can take a look at it and come up with something to work with. That's more than just literally there's just a handful of trades in here, 3 short codes and 4 long ones for the yen. I think that there are more. In other words, we can capture more of the moves, but I'm not sure yet. But I'm comfortable with that. The risk factors on those codes were very low. In other words, they had high trade qualities and of high enough frequency that I end up with a good system quality. System quality would be the total, sort of the total. If you take the total profit potential divided by the total number of trades you took, you get a feel for how well that system is performing. So the risk factors are very low, but the system quality is still good enough that it's worth doing. And that's what's running in 6E and GC and 6J. Now, what happened is I spent a lot of time on GC going through the same process I went through with CL. If you want more detail, there's you can watch the video on Sunday. That was almost an hour long, but it went into a lot of detail on exactly how that analysis works. And the issue is that I couldn't come up with a set of bucket size, frequency, and trade quality that yielded something that looked decent. All right, and the thinking there is that's because you don't have enough signals if there's not enough movement in that market. All right, but the dial that we have to turn for that is related to the speed of the chart. All right, so even like oil's is a market that's moving really well, but if you use a 20-tick range bar, you're never going to get any signals. It's the same thing with gold. The gold has been fairly quiet recently, though it's interesting here. We finally broke above 1,300 here, I see. But when I look back over the last 6 months, I don't see enough signals to work with to get to a point where I've got I could see high quality trades that occur at some frequency. Okay, so I have to do with gold the same thing I did with 6E, which means go to a faster chart. And that's a fair amount of work actually, because I have to change the chart itself, but then the model has to be rebuilt, since the model and the chart speed are intimately tied together. Okay, so that's all. I'm working on that this week. In the meantime, these are going to be running 6E, 6J, and GC are going to be running very conservative, and CL will be running with what I think is production level codes. All right, so that is it for today. Plus 95 for today. We'll see what the rest of the week brings, and I've got some work to do in gold. So take care.